Jeetu Panjabi, emerging market EM Capital Advisors, joins us in the show right now to talk about what to really make of this market right now. Jeetu, morning, long hiatus, welcome back to television.
Thank you.
But what's going on with the market? You know, like I just said, there are the usual Bajaj Finance, Maruti, HDFC Bank, but then you look at the broader market and you're like, is this even part of the market?
You know, I think the problem originates out in China. I think the core of the issue is the battle between Trump and China on the trade wars. The renminbi has gone down 8-9% of the last 3 months. That's a big deal. That's a really big deal. A lot of the Asian currencies are moving down in sync, and there's a lot of hot money fleeing out of Asia. And as that happens, you're seeing the pain play out all over this. Part two of the story is also, I think there was a lot of heat in these mid caps, and a lot of them had got ramped up, and not that great companies had moved up a lot. I think that correction is a fair correction to happen, but having said that, that creates a lot of opportunities, and that's what we should be fishing around today.
No, but how do you explain this dichotomy? Because it's lasted for a couple of months now. Typically, that differential trade doesn't last for more than a couple of weeks. And while you're saying it creates opportunities, what we're also understanding from channel checks is actually money is, because of lack of confidence, money is actually moving out from mid caps and getting into large caps. So then how does that confidence come back?
So I think there are some concerns around 2019 elections, and there's always this flight to safety when that happens. You could say there's a little bit of that, but I'd also say that I won't call it mid caps and large caps as the polarization. The way I kind of articulate it is good companies and not so good companies. Okay, so I can name...
But good companies are falling as well.
No, I can name a dozen good companies that are not that large cap, not very large caps, that are doing well. Take Sundaram Fasteners, for example, right? The stock has not corrected. I can name a dozen others, right? But the point is there are a lot of good companies that are doing really well, and the not so good are not doing well. I think it's very fair what's happening, and markets are pricing it well. Having said that, it's creating a lot of opportunities, and we need to be looking at the market and finding good businesses, good managements, and investing through that.
So where do you hunt between these good companies which are at, I'd say, good prices after the recent fall?
You know, the way I kind of think about it, I'll give you a couple of themes to think through, right? One, the financial sector. I think the financial sector is going to do exceptionally well. There's a big change happening here. Capital allocation is moving on to a meritocratic way of giving out money. Historically, there was a lot of crony capitalism. That is paused for a moment, for some time, and you're seeing money being doled out on a meritocratic basis. As you see that, you'll see a completely new set of companies that are working well and doing well. Not completely new, but I'd say the better guys are doing much better. Take the HDFC banks, take Bajaj Finance. 6 years ago, it was a $400 million market cap. Today, it's 15 billion.
But those are the well-discovered ones.
So the point is, the good guys who are doing the right things will be bigger, the profit pools will expand, and you'll do much better.
But those are compounding stories, right? What about alpha stories within the financial sector? I mean, what is it that you can buy at a fairly attractive price to, generate that outperformance?
I think the good guys will do better as a broad theme. Now, can you find a Bandhan that's going to be, or can you find an AU,
RBL,
or can you find a,
back,
or can you find, I mean, and there'd be M&A activity as that plays out. Take the IFLs and Edelweisers, and have they done well? Absolutely. And are you seeing their profit pool? Take their profit numbers 4 years ago. See the numbers today.
Insurance?
Right? I'm not very clued on to insurance in terms of are the valuations right. Yeah, you see the profit pools expanding, but I don't understand the valuations very well.
NBFC valuations?
I think there's a lot of runway. There's a lot of runway. The profit pools are going to expand in a very significant way. And that's an easy runway because there are a lot of new businesses being added to the NBFC suite. And you look at what's happening in the US, you see the opportunities there, you see stuff here. I think there's a long runway there. There's a long runway. Some of these will not be NBFCs for much longer. They could become banks, and they have a liability franchise. Things are going to change.
Okay, so financialization is that one theme. Where else do you hunt?
I think the second broad theme is that 24 million kids turning 20 each year, right? That's a large number, and so whether you
2.4 crores.
Yeah, and the point is, okay, let me add a slightly different perspective. What's happened over the last 3 years? We've had 4 sources of disequilibrium since 2014. In Jan 15, we had a fiscal tightening. In September 15, we had the Chinese deflation and the renminbi go down. Then you had demonetization, then you had GST. The last 12 months is the first period when you've had the macro and the growth runway to get some momentum without a source of disequilibrium. So what you're seeing now is that the high frequency data is looking really good. You look at the energy data, look at the auto sales, there's a lot of data. Now if you take that entire thing and see the guys who are doing well from a business standpoint and a profit pool standpoint, you'll see these guys get much, much bigger over time, and you've got to be positioned at the right place.
Jeetu, if you had $100, your top themes are financials, autos, and consumption.
Correct.
Allocate between these three sectors.
I'd kind of say 55, 22, 22 or something like that.
55 to financials?
Yeah, absolutely. Because the point is that business is scalable and as a profit pool that's going to expand much faster. Much faster.
That's very interesting. What about the global circuit? You know, what's happening with the globe and all these global gurus calling for a tough 2019. It doesn't impact us in the near term because I think what will be critical for us is the 2019 elections, and as we get closer to the day, the noise would get louder. But we are going to be influenced by, you know, global trends, where it seems like everybody's skeptical, even though the markets are at record highs.
So you remember our interview 2 years ago,
Yeah.
and which was I think May or June 16. Everybody was extremely skeptical.
It was just
But that was the beginning of the new 7-year cycle. The new 7-year cycle started in March or April 2016. We're in year 3 of that cycle. It's normal to find a pause in the cycle around that time. It's normal to see markets correct. We're going through that now. It lasts for about 12 months. We're going through that now. And I don't think the cycle analytics is as well understood to be able to map this. So when you do 40 years analytics on this and you see what's going on, it's pretty normal to see what's going on. When we spoke in 2016, we said next 2 years looks fantastic.
Yeah.
Okay, Europe's going to join the party somewhere halfway after a year or so. We've seen that play out. My sense is the macro's fine globally. It's the market that's got worries. A lot of the market worries are driven around the rhetoric. The rhetoric has been retaliated by Trump. The rhetoric has been retaliated by the renminbi going down 8-9%. That creates disequilibrium for businesses, and that creates worries for markets. I'm not particularly worried. My sense is that there will be sanity at the end of the day. There will be an equilibrium. It doesn't matter the renminbi is 6.8 or 6.7 or 6.9, so long as it doesn't break 6.9. But if it stays in that range, there is a disequilibrium. There's an equilibrium. Businesses adjust, and everybody kind of works their way around, and markets come back.
Got it.
So I'm not really worried. I'm actually pretty positive. I'm saying these are opportunities. I think the next 18 months looks pretty good, but the time to buy is now.
You don't believe that US equities are a little overheated?
No, when I look at my valuation models and I look at everything, I don't worry about it. Yeah, there are some sectors where there's a bit of heat, but the global cycle started around March or April 2016. There's a lot of runway. Now, to your point, am I worried about US? My first question, are the imbalances high? I don't see any major pocket of imbalances hitting the US from a near-term perspective. There are small pockets, like there's student debt, which is high, and there's a few other places. But there's no large imbalance that's sitting out there. Does this trade war turn out to be an imbalance that goes and breaks the back? Possible. Do we map it out? I can't. I mean, it's tough to figure out.
Final question, Jeetu. Rates going up. Trump has criticized that, but one can't help it because after a 10-year cycle, which is either way prolonged, rates need to go up. Now, it's not just about whether they should go up, but they need to go up. Is that a big risk?
No. Take 2003 to 2008. There were 13 rate hikes. The markets went up 150%. So rate hikes are essentially telling you the economy is better. It can afford a higher cost of capital, which is a better price. And so long as your ability to create value from an ROE perspective is strong. Right now, all the data is telling you the ability to create ROE is strong. Yeah. When you have a 16% ROE in the US, can you afford to spend another 50, 75 bips of cost of capital? Absolutely. I don't see that as an issue. So I'm not really worried about that.
All right, Jeetu, we leave it at that. Thanks very much for taking out the time and coming to our studios.
Thank you for having me.
Great to speak to you.